So what I want to talk about in this lecture are what are called amortized loans, right? These are loans like mortgages that you take out to buy a house or car loans, for example. These are loans that have a fixed interest rate, usually. For purposes of our calculations, we're going to assume a fixed interest rate. And they have a fixed principal. You borrow a certain amount, you do it once, and that's it, and then you make payments until the loan is paid off. And so the key question that we're going to want to ask in these scenarios is, given the amount you want to borrow and the interest rate you're being offered on the loan, what is your monthly payment? Right? How much are you going to have to pay to cover paying back both the principal, the amount you borrowed, as well as interest on that principal? And there's a formula for this, obviously. And I realize it looks a hot flaming mess, but if you take a step back and look at this for a minute, it's really not quite as crazy as it looks. These two formulas are equivalent. The right-hand one, I've taken the left-hand one, solved it for R, and done some simplifying. You see this right-hand one in a lot of textbooks. It's nice because it takes you directly to the R value, which is the monthly payment, without any additional calculations. Personally, I know the left-hand one looks a little messier, but that's the one I prefer, because for me, truly it is easier to remember, right? And here's why. If you look closely, the formula on the left here, this is the compound interest formula. And this expression on the right, this is the formula for the future value of an annuity. I never want to memorize a new formula if I don't have to. And that one on the right, while it may be simpler, it's a new formula that I'm going to have to put on an index card, that I'm going to have to memorize, remember to look up, or whatever. This left-hand one is based on two formulas that I already know. And for me, that just always makes my life a little bit easier. All right, so that's going to be the one I'm usually going to be playing off of here. And just kind of real quick, the reasoning behind this formula goes something like this. Let's say you want to borrow money for a car, say $10,000, right? The bank has $10,000 sitting around that they can loan you. This is great. Well, they could just take that money, put it in the equivalent of a savings account, right, and let it sit. And if they did, this would be how much they would end up with at the end of the loan period, right? For this to be a good investment for them, the amount they make from the borrower has to be at least equal to what they could get from this sure bet, put in a bank account and let it sit, right? So if they're getting monthly payments from you, well, from the perspective of the bank, that's an annuity, right? They're getting these monthly payments that they could put into this investment and earn interest on it, just like you would, an individual investor, if you purchased some kind of annuity. So that's the reasoning here. The money that the bank earns from the monthly payments you give them needs to be equal to what they would earn if they just took that lump sum and put it in some kind of basic interest earning investment account. Okay. So let's take an example. Right, suppose you want to buy a car, $12,000. Got an interest rate 5.4%. You're going to make monthly payments, and you're going to be doing this for 5 years. So I want to know, what will be your monthly payment? All right, well, let's start the way I always like to start. Let's pull out the key information here. All right. What is the principal? Well, that's the amount of the loan. That's $12,000. What is the interest rate? That's 0.054. Let's see. N is monthly, right? So it's going to be 12. And T is 5 years. All right, so now we go to our formula, right? P1 plus R over N to the NT power, R1 plus R over N to the NT power minus 1 all over R over N. Now you put your numbers in. There's obviously a lot of calculator work here, right? 12,001 plus 0.054 divided by 12 equals R1 plus 0.054 divided by 12 to the 12 times 5 power minus 1 over 0.054 divided by 12. Now you go to your calculator, right? And you do both sides. And if you do this, you get 15,710.0552 equals 68.70473 R. Now, if you're doing this on your own, right, on your calculator, remember, don't round numbers until you absolutely have to. I would do this whole thing as one pass, using as many decimal points worth of accuracy as my calculator would give me. Remember, when we're doing these financial calculations, rounding error can become a significant issue, right? So you always want to use the maximum accuracy possible. I know for convenience here, I've only done this to 4 or 5 decimal places. If you're writing these numbers down rather than using a memory feature on your calculator, I would write them out, as annoying as it is, I would write them out as far as the calculator gave me. All right, so now we can get to the final answer just by dividing both sides by 68. I'm going to do both sides. 68.70473. And if you do that, you get that R is equal to 228.66. $228.66. Rounded to the nearest penny, right? And there's our answer, right? That's what we were looking for. If you like, feel free use the other formula if you like, right? You're welcome to plug the numbers into there, just for practice and confirmation. You should get the same result. Okay, so now we've got a similar situation here. We're talking about a house this time instead of a car loan. So obviously the price is a little higher. The interest rate is a little better, and the period is a lot longer. 30 and 15 years are kind of the standard amounts for mortgages. So I want to know, what will be the monthly payment if you make a 10% down payment, and how much interest will you pay? Okay, well, the idea behind a down payment, this is very common with home loans, with mortgages. The bank is going to expect you to have some of the money up front. It's a little unusual for them to be willing to loan you the entire amount. All right, so let's see. This is a 10% down payment means you have to have 10% in your bank account. All right, so let's figure out what that is. 10% of $250,000 is $25,000. Okay, you already have that money, right? You're not going to need to borrow that part. So the principal, the amount you're actually going to be borrowing, is the $250,000 minus that $25,000. So the principal here is going to be $225,000 rather than the original $250,000. Okay, now we're ready to go to the formula. Right, and if you like, you can pause here real quick, work through the formula yourself, right? Get some practice in, see what you end up with, then come back and you can see how I do it. All right, so excuse me. So let's see. We've got R is 0.035, and as it commonly is, right? That's 12. We're doing this monthly, and T is 30 years. So you're going to go to formula, whichever one you're using. I'm going to use the one from the left-hand side. I'll write it down again here. R over N to the NT equals R. 1 plus R over N to the NT minus 1 over R over N. And if you put those numbers in, do the calculation, get me very careful with your calculator, you should get 641,989.6122 equals 635.4127R. Divide both sides by that 635. Figure 635.4127. You should get your monthly payment is $1,010.35. Okay, now, what's the interest? Right? What's the interest here? Well, how do we find interest? This is an area where I see students, sometimes they just go a little crazy, right? They try to whip out the compound interest formula or simple, strange things happen. It's much easier than that, right? It's much easier than that. You know how much you borrowed, right? That's this P here. And you know how much you paid, right? You paid this monthly payment, $1,010.35, times how many payments did you make? Well, there's 12 payments times 12 payments per year times 30 years, right? That's how much you paid to the bank over the course of this loan, right? Let me see if I figure this out. Go to my calculator. 10,10,35 times 12 times 30. This is $363. $363,726. Right, so how much did you pay in interest? Well, take how much you paid, subtract out, and be careful here, subtract out how much you borrowed, not how much the house cost, right? We only borrowed $225,000, right? So if you do that calculation, you should come out to $138,726.20. Okay, so I want you to stop and think about this for a minute, right? I want you to stop and think about this. You borrowed $225,000, and you ended up paying $138,000 in interest. That's more than half the cost of the house, right? $250,000 divided by 2 is $125,000. Right? This is the problem with long-term loans, right? If you stretch a loan out for a long period of time, now this compound interest thing is working against you, right? When we're talking about investments, long-terms were good, because then compound interest was generating large interest rates, and those are going into your pocket. Here's the reverse, right? Here, this long loan period is working to the bank's advantage. So just as a general rule, when you're taking out loans, quicker is always better, right? If I have the option of taking a 15-year loan versus a 30-year loan, yeah, I'm going to take that 15. Right, because my payments are going to be more, right? Because I'm paying it off faster. But I am paying it off faster, so more money is going to pay off the loan, less money is going to the bank in interest. All right, so before we move on, I want to talk about the elements of a home loan. When we're talking about how much your monthly payment is going to be, the calculations that we were just doing were based on, first, paying back the principal, paying back the actual loan itself, and second, paying back interest. Your monthly payment will be more than that. Okay, because there are other things that the bank is going to expect you to pay. When you own land, when you own a house, one thing you have to pay every year are property taxes. You are going to pay that, not the bank. The bank, however, wants to be sure that when the end of the year rolls around and that bill comes out from your county property appraiser, that you have that money. Right? So to make sure they do, they have a good idea of what your taxes are going to be next year based on what they are this year. So what they do is they take that amount, divide it by 12, and add that onto your payment amount. Right? So if they project based on last year's numbers that this year at the end of the year you're going to owe $1,200 in property taxes, they're going to take that, divide it by your 12 monthly payments, and add an additional $100 onto your monthly payment amount. And what they're going to do is they're going to take that money and they're going to put it in a special kind of account. It's called an escrow account. Right? And an escrow account it's just kind of a holding account. It doesn't usually earn interest. I suppose it could, but it doesn't usually earn interest. It's just a place to hold money for a later date. All right, and then what will happen is at the end of the year, the taxing authority, the property appraiser, whoever does that in your county, will do two things. First, they'll send you a tax statement, and when I get mine every year, when I've had a mortgage, it says at the top in really big letters, "This is not a bill. Do not pay this," because they've also sent a copy to the bank because they know who's holding your mortgage. They've also sent a copy to the bank, and the bank will actually make the payment out of that escrow account. And there actually is a second thing as well. The bank is going to insist that you have property insurance. If for whatever reason the house is damaged, God forbid it burns down, whatever, the bank is still going to expect to get paid. Right? So they're going to expect you to carry insurance on the house, and this is handled the same way. You'll let the insurance company you choose know who your bank is. They will send the bank a bill every year, and it works the same way. The bank has a really good idea based on last year's payment what this year's payments are going to be. They're going to divide that by 12, add that onto your monthly payment, and that money will also go into your escrow account. So once again, you'll get a statement from your insurance company, but the actual bill will go to your bank, and your bank will pay that out of the escrow account. Okay, so that's installment loans, right? What are we going to do next? Well, another kind of loan that a lot of people have is a credit card, right? It's a variable loan. It's a loan where the principal changes sometimes on a daily basis, depending on how frequently you use that card. So in the next lecture, we're going to take a look at credit cards, see how interest is calculated, and how they calculate your monthly payments.